So you just found a storage deal that checks all the boxes. It looks like it's a great market. It looks like it's going to have solid returns, room to add value, and your gut tells you, move forward, this could be the one. But then reality sets in, you start to hesitate, maybe your knees weak, hands get sweaty, whatever Eminem says, and you start overanalyzing. You start playing with the numbers, you start figuring out how to break the deal. And that could actually be a good thing if you are willing to move forward. Because one of the things I always tell myself is that if I can't break the deal, it's a deal. If I can't figure out why not to proceed, then it's a deal. The problem is a lot of people let fear take over. You start wondering what you might be missing. And then all the while, several people are sending a letter of intent. And someone is going to lock up a really, really good deal. I say this all the time inside of our Storage Wins community coaching calls that good deals do not die because they're bad. Otherwise, they wouldn't be good deals. They die in the gap between interest and action. And I shared that in my last video and in the last podcast, is you need to learn how to bridge that gap between interest and action. So in this episode, what I'm going to do is I'm going to walk you through our Storage Wins execution playbook. This is exactly what you do once you find a deal you like. And it's a step-by-step guide from green light to LOI to a contract to a close. All right. Now, I had a conversation on one of our community calls, and somebody asked a question, and one of our members was getting stuck. Found a great facility, ran the numbers. He knew he was trusting his process up until the point that he wanted to send a letter of intent. And then he started overthinking everything. He started checking the competition again and the market and the exit cap and the insurance costs. And he was just looking for reasons to slow down the process, even though he knows our process really, really well. And he trusted the process, but when it came time to make that leap, he started getting the sweaty palms. The knees started getting a little weak. Now, fortunately for him, he had a community of people that were there to breathe confidence into him. And he realized that he was just getting stuck in fear and uncertainty and analysis paralysis. And he decided to go ahead and follow what we had taught him. And he ended up getting that letter of intent accepted. Now, I don't know if the deal is going to close or not, but that's not the point. The point is he wouldn't have had an opportunity at it had he stayed stuck in fear, had he stayed stuck in analysis paralysis, right? He nothing magical happened, by the way. He just followed our process, our roadmap, our blueprint here that I'm going to share with you. And look, this is what I want for you. I want to take you from confusion to clarity and confidence and start building momentum so that when a deal hits your inbox, you have confidence. You know how to look at it. You know how to analyze the market, the competition, the supply and demand in the area. You can get a pretty good feel for CapEx, capital expenditures. In other words, what work needs to be done to the facility. You can quickly do some back of the napkin analysis, some quick math to determine if it's even worth diving a little bit deeper. You understand how to have the conversation with the seller or broker and collect the necessary information to then dive deeper and determine what it is that you want to offer, so that then you can put together a simple 1 to 2 page letter of intent, send that offer, start continuing to build a relationship with the owner or the broker, and then start to bridge that gap from interest to action. And that is what it's all about, because speed wins, and speed comes from understanding the process. People think that fast movers can be reckless. I don't necessarily believe that. Now, you can't just move into every deal and just start sending a bunch of offers without going through a certain process, right? You need to be very mindful and intentional that if you send an offer and they accept it, you are committed to closing this. Now, you're going to have a due diligence period, of course, where you get to dot I's, cross T's, and verify everything. But you don't want to just be sending out letters of intent or making offers if you have no intention of closing, if you're just throwing a bunch of stuff against the wall to see what sticks. But I want you to be prepared. And I shared this in the previous one, but preparation breeds confidence. And so I want you to have the same level of certainty. I want to, again, take you from confusion to clarity and confidence. And once you have clarity and confidence, that's going to give you a certain level of certainty. Now, I'll preface this by saying that of all the storage deals I've closed, I don't think I've ever gone into a deal feeling like I have every single base covered. what I mean by that is not that I haven't done my homework, not that I haven't prepared, not that I haven't looked at every angle possible, not that I haven't looked to mitigate risk and understand where the landmines are in the deal. And if this happens, then how are we going to counteract it? And what's plan B if that doesn't work? But you're always going to have some questions, right? You're not always going to have every single answer. And I always tell people, we want to be 85 to 90% confident. And leave yourself a little bit of wiggle room, because we don't have a crystal ball and we don't know what's coming up. But we prepare, we do our homework, we have the necessary conversations, we go through the right process. So look, phase one is the goal. Think of it as like a triage, right? The goal of triage is not perfection, it's speed. What I want to quickly figure out when I see an opportunity is that, hey, is this deal worth me sending a letter of intent? All right. And so what I do whenever I see an opportunity, first thing I usually do is I just do a quick location check. I'm looking at, I pull it up on Google Maps. I look at the street view. I get a sense for the competition in the area. How many facilities are in the area? Does it look like an overpopulated area? I'm looking at, are there any REITs in the area, like Public Storage, Extra Space, Cube Smart? Because for the most part, I don't want to be playing in those sandboxes. I want to be in smaller markets where I can be the market leader. I can be the sophisticated operator amongst a bunch of unsophisticated operators. Of course, I'm looking at certain demographics like the medium household income. I want to make sure I'm in a population and in a city where there's job growth and people are coming in. It's growing. I want ideally a low square foot per capita, right? In other words, what is the amount of net rentable square footage of storage relative to the population in that area? And really what that determines is essentially the supply and demand. It's just a metric to figure out, is there more supply of storage than there is demand, or is there more demand for storage than there is supply? And I want to be in the latter. I want to be in a market where there's more demand for storage, because that will allow me to increase occupancy, generate more revenue, and ultimately more net operating income, which is what determines the value of these storage facilities. It's the income the asset produces. So after I do just a quick health check on Google, market visibility, competitors, where is it located, what kind of traffic, is it on a main road, is it kind of hidden? I'm just starting to piece together, how do I see this deal? Right? I'm kind of giving it like a grade right now. Is it an A, a B, a C, a D? Or an F, and I'm judging it based on all these different factors, and I'm looking like, is it close to the water? And if it's close to the water, if it's somewhere in Florida on the coast, or if it's in Louisiana, I'm already going to know that, hey, insurance is going to be pretty expensive here, and that's going to have an impact on my numbers. Now, I'm not trying to kill a deal at this point. I'm just getting a lay of the land. All right, and then it gets to the point where I want to do my quick back of the napkin analysis, and there's several different ways you can do this, but the easy way is if I can just find out what the monthly or the annual revenue is, right? Then all I need to do is, typically in storage, the operating expense ratio is between 35 and 40% on average, I would say. Of course, there's factors like the market, the size of the facility. There's some factors like that, but let's just assume, for simple math, we're going to be conservative. Let's just assume a 40% operating expense ratio. Now, I'm not saying you can't operate storage facilities for 30 to 35% operating expense ratios. You can in certain cases, depending on the size of the facility, the market, how you're going to run it. But for simple math, let's just assume a 40% operating expense ratio. So what does that mean? Well, for every dollar of revenue that facility generates, it's going to take 40 cents to operate it, right? 40% of that number. So simple math, if the facility is generating $100,000 in revenue, in annual revenue, it's going to take about $40,000 in operating expenses to run it, to generate that $100,000. So if you just can figure out the monthly revenue or the annual revenue, and by the way, we have an offer range calculator and a cap rate calculator that I'm happy to share with you. We'll include a link somewhere in here. There'll be a link where you can actually get access to that for free. So that will really help you when it comes to just getting a quick pulse on what's the value of the facility. But anyways, all we're doing is taking the monthly revenue and we're annualizing it. So you multiply it by 12, and then I back out the 40% operating expense ratio. So I will typically take that annual revenue number, multiply it by 60% to back out the 40% in operating expense ratio. And then from there, I have my NOI. Okay. I have my net operating income. And then now I can apply a cap rate to that NOI. And that will give me an overall value. And a cap rate is just an expression of value. It's essentially telling you what is the return on your investment if you were going to buy that property cash. So keep something in mind is that I'm always looking at the value of a facility based on the NOI today. I'm not paying for future upside that they haven't created that value. I'm not buying things or making an offer based on pro forma. Now, yes, when I dive deeper into my underwriting, I absolutely want to see what is that gap? What is the delta between the current NOI, the current net operating income, and what would the NOI be once I execute on my value add strategy, once I raise the rents, once I include fee income, once I do certain things. I'm absolutely going to see what my upside is and then determine the value based on a certain cap rate. So I am looking at what it's producing and what it could produce if I were to operate it to see what kind of delta, what kind of gap do I have? Where is my upside? But I'm not making an offer based on that future value. I'm making an offer based on what it is today. All right. One other thing I mentioned is I do I forgot to mention, I should say, is I do a red flag scan, which means I talked about how if it's a facility in Florida, Louisiana, I'm looking at, is it in a flood zone? Is insurance going to be an issue? I'm also looking at crime. And, that is a mistake I made when I bought my first storage facility. I bought it right. And so when I sold it, I did really well with it, but it was in a high crime area. And with high crime came more management issues and it was an operational heavy lift. And that's not why I got into storage. So I learned a ton going through that process. And fortunately, I was able to do well because I bought it right. But I really cut my teeth as a storage owner and operator in a really, really difficult market. So you want to do just a quick scan, health check of the market, crime, flood zones, all that type of stuff. And then if you're dealing with a broker, to the best of your ability, try to really understand what's the seller's situation. Why are they selling? What's their timeline? Are they price sensitive? Are they open to terms? Is there any existing debt? Could we do something creative? If you're dealing directly with a seller, then it's easy. It's easier, I should say. You can have a direct conversation with them. And then from there, it's figuring out, something we call in our community the funding options map, which is the various different ways you can get a deal funded. And that could be SBA financing. That could be a small local bank, seller financing. You have private lenders, bridge financing. There's a hybrid of some of these things. So I'm just getting an overall lay of the land on the deal. And then I move to fast underwriting. And my fast underwriting process is in less than an hour, where I'm diving deep into my spreadsheet to really determine, hey, where is that upside? And this is what I'm looking at when I typically have now. I have more information. I might have the T12, which is the trailing 12, the financials for the last 12 months. I'll look at occupancy reports to see if it's seasonal or not. I'll look at the seller's expenses, even though I'm going to underwrite the deal. I'm going to evaluate it based on my expenses. And this is where I start to go line item by line item. And in some cases, you have to make some guesstimates, but then you're going to verify that later. All right. But so once I go through that process, I'm looking at income and expenses. All right. I'm looking at the profit and loss statement. I'm checking where their current rents are and where the rates are and what's the average of the market rates. And one of the things that I think is super, super important is when I look at a deal, I'm looking at what is my worst case scenario. I'm looking at what is my likely scenario. And then I look at what is the best case scenario. Never, ever, ever buy a storage facility based on the best case scenario. You want to buy ideally based on the worst case scenario, because if you can make the numbers work and you can make the deal work on the worst case scenario, then you're likely going to achieve the likely scenario, and everything else is gravy and upside. But I'll never buy if everything breaks right. I think that's a recipe for disaster. All right. So from there, I'm evaluating the deal, and then I'm looking at is this a deal where it makes sense from an equity perspective? In other words, what's the future value? What is oftentimes referred to as the reversion sales price. Essentially, if I bought it for $1 million today, what's it going to be worth in 1 year, 2 years, 3 years, 4 years, 5 years, based on some modest conservative projections? All right. And then I'm looking, okay, well, if I'm buying it for $1 million, but I can only sell it for 1.2 in 3 years, there's not a whole lot of room there, especially if you're going to use a broker to sell the facility. They're going to take their commission's going to eat up some of that profit. You got closing costs and other expenses. Like, the juice is not worth the squeeze there. But what if in 3 years that deal's worth 1.7 or 1.8 and you're buying it for $1 million or even more, right? Now we're cooking. Okay. I'll also look at, hey, what's the cash flow if this facility were bought cash? In other words, revenue minus expenses is NOI. If I were going to buy this cash, which I'm not, but if I were, what's the NOI? And then I'm going to layer on financing. And I'm going to look at, okay, well, if I had to put 30% down and I went to a bank and got 70% financing based on today's rates, what is my debt service? And understand something that's really, really important. Banks look at something called, if you're gonna work with a bank, there's something that is super important to every bank I've ever dealt with. It's the DSCR, and that's the debt service coverage ratio. Banks look for a debt service coverage ratio of minimum 1.25. Some banks are looking for 1.3 these days. What does that mean? That means that if your facility is generating, let's just use simple math. If your facility is generating $125,000 in net operating income. Again, what is NOI? Revenue minus expenses is your NOI. If your facility is generating $125,000 in annual NOI, your debt service cannot be any more than $100,000. Okay? If it's less, fantastic. That just means you have a higher DSCR. But if your debt, let's say, is $115,000 and you're generating $125 in NOI, that's not going to cut it. So if you just take the NOI divided by the debt, that will give you that amount. All right. So they're looking for minimum 1.25, in some cases 1.3. And as a pro tip, if you are negotiating directly with a seller and you run your numbers and the DSCR, the debt service coverage ratio, is coming in less than that 1.25, show that to the seller and say, hey, Mr. Seller, like, I understand you might own this facility free and clear, but I'm going to need to get a bank loan to purchase your facility. And banks require a 1.25 or a 1.3 debt service coverage ratio. They want to make sure that I have enough income coming in from this business, from this facility, from this asset to be able to service the loan and pay the loan, right? Because banks are in the business of lending money to grow money, but also like evaluating risk, and they want to minimize that risk. So we'll look at the DSCR in our spreadsheet. It'll tell us what our cash on cash return is, and it'll give us other metrics. So you're really trying to figure out, what's the play here? And does this fit my buy box blueprint? Does this fit what I'm looking for? And when you finally determine, hey, this works, you got to ask yourself, okay, well, do you have the down payment if you're going to work with a bank? Or is this a seller financing structure? Whenever we present an offer, I like to make 3 offers. One of those is a seller financed offer. Sometimes I'll do a hybrid. I'll do another offer that's going to involve a down payment with bank financing or some type of loan. It really depends. We look at every deal differently. There's not a one size fits all. But when we determine that it's a deal and there's a green light, that's where now we're going to figure out what to offer and take that onto an LOI. Okay, this is our letter of intent. This is the bridge from interest to analysis to now action. And the positioning matters more than your price, okay? Because you want to make it easy for them to say yes to you if you really want the deal. And you want to be the easy button, the buyer who is fast, clean, certain. It's not always about the highest price, but they are going to evaluate price, of course, but they're also going to evaluate the terms of the offer. And they're also going to evaluate you. So make no mistake about it, is that this is a sales process through and through. And your price is just one of the factors. So now in your LOI, I want to quickly talk about what to include there. Maybe I'll do a dedicated video kind of breaking down a letter of intent, but Obviously, it's going to have your contact information, all of that kind of stuff. It's going to have the address of the property, the seller's name, the legal name. Obviously, you can look that up in the public records. Your name or the entity you're going to be purchasing it in, your offer price or the purchase price, the structure. Is this a cash deal? Is it a financing deal? What is your earnest money? Typically, I would say 1 to 2% earnest money makes sense, depending on the area, the facility, if it's a broker involved, all that kind of stuff. But you want to make sure that earnest money is refundable during the due diligence period. Ideally, I would like for you to get a 45-day. If you can get a 60-day due diligence period, great. It can be done in 30 days, but if it's your first deal, that might be a little bit tight. Now, if you have a coach or a mentor or community, if you're part of like Storage Wins, then you have a lot more guidance and support, and that will help simplify the process for you. But generally speaking, I would say you want to get at least 45 days. After that, if you can get 45-day closing after that due diligence period, that just gives you some breathing room. One of the things I always like to do is build into my offer that I have one 30-day extension if requested. All right. And that just buys you some additional breathing room. But those are also things that I'm willing to remove if need be, if it gets down to a negotiation. There's going to be financing contingencies. You're going to do certain environmental reports, like a phase 1. You may have to do a phase 2 depending, but not typically. There may be an appraisal involved if there's a bank and, that kind of stuff. So when you send your letter of intent, I always, and this is one of the things I coach my Storage Wins clients on, attach your buyer info sheet, right? Think of that as your resume. And it also has some information about you personally, hobbies, family, your experience. It's just think of a one-page bio, a one-page resume. If you have a lender pre-qual letter, a proof of funds, include that for sure. If you have testimonials or character references, include that. It's not going to hurt. It can only help. And that instantly communicates to the broker and whoever's evaluating that, the lender, the banker, hey, this person's legit. This person's real. And I'll submit that LOI with an email I'm not writing a marathon or a book. I want to make it easy for them to consume and see what I have. I'll never talk bad about the facility or the property. In fact, I'll boost it up. And that might be counterintuitive to a lot of people, but hey, Mr. Broker, hey, seller, we really like this facility, and we can move fast if it makes sense for you. Attached is our LOI. We focus on certainty and speed, and we pride ourselves in that. And it looks like this could fit what we're looking for. So happy to jump on a quick call if you want to go through this in details. In detail. That's it. It's simple, clean, professional. You have your contact information there. In our LOI, I don't leave it open-ended. I think I usually leave like a 72-hour period or maybe a 5-day period for them to be able to accept it. You don't need to over-explain, just communicate with confidence. That's really, really important. And then, once your LOI is accepted, congratulations. That is the first step. You then typically have like a 3-day window or so in which you're going to work with your attorney. They may have their attorney, and you're going to start getting them connected and working on the purchase and sale agreement. And the LOI is just essentially it outlines, hey, here are the terms of our offer, but it's not a legally binding document. But it's showing your intent. It's goodwill. It's saying, hey, we're gonna walk together. We're gonna do this dance. And let's now take this on to a purchase and sale agreement. So that is the whole process pretty much. I mean, granted, there's a few moving parts in the middle there, but don't overcomplicate this. Like, don't worry about steps 4, 5, and 6. Worry about steps 1, 2, and 3. Because deals are won, understand this, deals are won by people who move with clarity and confidence. Not by those that are always waiting for the stars to align and for them to be certain about every aspect of the deal. Remember that you can fix the numbers, you can fix the structure, but when you get caught in that analysis paralysis and hesitation, you get stuck in quicksand and you just sink. Okay, so don't get stuck in quicksand. The next time you find a facility you like, go back to this training. Go back to what I've shared here with you. Like look at the market, do a quick health check, do your back of the napkin analysis, underwrite the deal, take the time you need to go a little bit deeper, figure out what you want to offer, send the LOI. That's how storage winners win, while everybody else is just browsing LoopNet and Crexy and looking at deals but not really doing anything. So look, if this episode helped you see the path from deal to contract, and it gives you confusion, it takes you from confusion to clarity and confidence, make sure that you're subscribed to the Storage Wins podcast. Every single week I'm releasing new episodes. Make sure that you're also subscribed on the YouTube channel so you get notified with new videos every single week. And look, if you want to have access to everything you need, and you want to have it with the guidance and the support, with the right coaching, mentorship, and people that are going to walk alongside you and breathe life into you and help you in your storage business, I want to encourage you, book a discovery call. It's super short, just an opportunity to see if it's a fit, storagewins.com. And this is for people that are serious about buying their first storage facility within the next 6 to maybe 12 months max. So if that's you, head over to storagewins.com. And remember, something I shared in the previous video, speed does not come from rushing. It comes from readiness. But don't wait for everything to be perfect before you shoot your shot.